I'm Charlotte McLeod with the Investing News Network, and here today with me is Paul Sousa, Senior Vice President and Investment Advisor at Sightline Wealth Management. Thank you so much for being here with me once again online.
Thanks, Charlotte. Thanks for having me. Nice to see you again.
Yeah, nice to see you again. And this is our first conversation of the new year. So I want to start off with a quick recap of 2020. I remember from talking to you previously that you work with high net worth clients. So I want to ask how you went about guiding them through last year.
Sure. Well, actually, guiding through last year started years ago. So, there's an old saying is, it wasn't raining when Noah built the ark. And, we take that advice to heart. And that is we diversified portfolios. There's always market dislocations. No one predicted exactly this pandemic and that would occur and how swiftly we went into a bear market. However, the portfolios were set up in such a way that it minimized downside capture. And that's the essence of how we set up portfolios. We're not so concerned about capturing all the upside as important. What's most important is not capturing all the downside. In fact, absolute returns are something that we strive for. And so we really rode through March, April, May, through the depths of that bear market and that swift correction. A lot of the alternative funds that we used had positive returns through that time period. So that kept clients extremely, they were very happy that they were invested in that. Obviously, they had questions in terms of how the underlying investments were performing, how would they perform. And so we were quite very busily speaking to all the portfolio managers. And I think that's a testament to the due diligence and the ongoing monitoring and the quality of the loans in terms of the portfolios and the strategies that we use. So it was clear sailing and really minimized that 35% correction.
Well, that sounds good. And speaking of questions that you're receiving, I wondered if there were any particular areas that people were becoming more interested in or common concerns that you found people coming to you with. What was that like?
Yeah, I think first and foremost is any business that would suffer as a result of the lockdowns and the social distancing and the quarantining. So commercial real estate, everyone was really looking at those assets. Industrial real estate was doing well, perhaps commercial may not be. Technology companies obviously were a great benefactor of this. Initially, gold wasn't, but after the stimulus was announced and the trillions of dollars printed, then obviously more money flew into that asset class. But once again, we always have an allocation of gold, so it wasn't a surprise, and we were prepared for that.
All right. So now that we have a little bit of an idea of how 2020 went for you and your clients, can you give me an idea of what you see coming in 2021? And I think a key question here is where we're at in the COVID-19 recovery. So what are you seeing there?
Okay, so we have Trump out of office, so I think many people are happy about that. Frankly, the fact that he's not in the news every single day now is a little bit refreshing, and that's not me having calling the party lines here. So there's 2 vaccines that are approved, more along the way. The Democrats are known for spending. Interest rates are low, close to zero. We think they're going to stay low. Fed will continue to print money. In fact, central banks around the world will continue to print money. Saving rates are high. Just speaking to clients that have actually been able to, and the average person too as well, save a lot more from staying home for the last year now. And so, the IMF is forecasting an expansionary year this year. China's already at full capacity. So it all looks good in 2021. However, we want to temper those expectations as well. And, the vaccine could be delayed. There may not be as much stimulus as people, think there might be. So we want to hedge that as well. And so the portfolios aren't set up geared for one particular outcome, is geared for all outcomes.
Right. And, even as we've had the coronavirus having a major impact everywhere, we have seen the major stock indexes in the US continue to move up. Do you see that continuing? And how does that relate to a Biden presidency and perhaps what you're doing to manage the money you're in charge of?
Um, yeah, I think it could in terms of the vaccine. I mean, the narrative is people eventually get back to work and the economy will get back to its full capacity. The JP Morgan Composite Purchasing Managers Index is indicating we're in expansionary territory already. There's still large unemployment. However, um, we think that may get worked out, or they may restructure themselves and find different employment. As I said, China's already full capacity. The IMF is experiencing recovery. There's also um, after so a particular asset class within or style within equities. Individuals oscillate between, say, growth and value managers. Value managers or value stocks tend to have large returns after a bear market or after a recession. And the average is something like 45% excess returns over the index, over its benchmark, in about a 24-month period after recession. So, if investors want to sort of cycle, rotate maybe away from growth, it's had an extraordinary year, and not necessarily move entirely out of it or rotate entirely, but perhaps take some positions off the table, rotate. You want to buy low, and value managers have been beat up very hard over the last number of years. So it's probably a very good place to place some assets.
Right. And speaking about where to focus attention for investors, I know in the past you've spoken about the importance of diversification and also the importance of not taking on excess risk as people might be tempted to do in a low interest rate environment. So at the moment, which assets would you say embody that cross point of being diverse but not putting yourself into too much risk?
Just speaking to a colleague, part of our team, we have a pension consultant, and we set up our portfolios just like an endowment would, or institutional investor. So we have a fairly large allocation for the right investor to alternatives. And one such strategy, the mandate is between 5 to 7% return, maybe 5 to 8% return, and the process is one that's extremely risk adverse while generating those returns. However, the sectors and the markets that they're investing in have had phenomenal tailwinds this past year, last 2 years, and it's returned in the mid 30s, about 35% return. We don't know how that will look this year, and so what I'm suggesting to clients is continue to add to that particular manager, to that strategy, for the reason that may have another tailwind and do extraordinarily well. However, it's like riding this wave where it won't crash at shoreline, will you be wiped out? It'll actually just come back down to that 5 to 8% return. So of all of our strategies, it's one that is just extraordinarily good risk return profile. A lot of our private debt strategies, these managers have taken the crisis to add to their positions, extend new loans, companies that they haven't, the fundamentals they haven't seen in quite some time. So in every crisis, there is opportunity. And so again, with skilled managers, they've taken advantage of this, and the portfolios are looking really strong. So there's also, you want to look at, healthcare, technology, anything cyclical in terms of, in addition, consumer discretionary, maybe not so much. So again, that's getting into the weeds of sector picking. So, we go back to, we talk around the office and our team about certain themes. However, we really do focus on the asset allocation, and then the strong due diligence on these portfolio managers and strategies that are just simply not available to, say, retail investors. We, through our parent company, we have, the ability to partner, say, or invest with a firm that may have a minimum of $10 million. However, it's set up through a prospectus offering or a offering memorandum here in Canada, and for a minimum investment of 25,000. So we really make that available. We democratize that investment, or just make it accessible to many. So, long answer to your question. Yeah, there's a few that are just provide just an outstanding risk reward opportunity today.
Okay, well, that's great. And I have a question now that I'm throwing in as maybe a fun, timely topic to discuss, which is what's been going on this week and I guess recently with GameStop. We've seen over the last year or so, I think a lot of new investors come into the space, and it's really now centralizing around GameStop and other stocks. So, what are your thoughts there? And I want to know if you think it's good to see these people coming in, or is this too much or the wrong type of activity? What do you think when you see these things happening?
Well, it's interesting. I got a text from my son this morning. He's 14, and he asked me, have you been following GameStop? And so he's on a few Reddit boards, and so we toggle off to the right. It's what's in the news. So he's a curious kid. He read into it, and so it's very timely. So just for the viewers, if they're not following it, GameStop's a physical gaming CD company. So think of Blockbuster years ago before it went bankrupt. And so the fundamentals of this company actually do not look good whatsoever. Every games are now downloaded, available on the cloud. You don't need to purchase I'm sounding old here, a CD. So there's a hedge fund company, firm that was short GameStop. And so a group of individuals on a forum sort of put together a thesis and say, let's buy shares of this company to make it rise. And then this hedge fund will have to cover their shorts. And so that's what happened. And individuals, partially this started back last year where there was no sports. So those who usually bet in sports turned to the stock market. And so, it's quite ingenious, actually. I mean, I'm not quite sure to think about it. I have pros and cons to this, but essentially they're not doing anything that Wall Street doesn't already do. And Wall Street's actually getting a bit upset over this. But it's a bit hypocritical because it happens all the time. So, end of this story, we have this hedge fund firm who's short GameStop, almost went under. They had to shore up, I think $1 billion from outside capital to shore up their balance sheet. And GameStop, so these individuals have made just extraordinary returns. It's no different as well as, so famously, Bill Ackerman put a short position out on Herbalife. And that's a 5-year position where he thought this is a multi-level pyramid scheme. And so he put out a large paper documenting his thesis and why he thought the shares, were grossly overvalued. Carl Icahn says, I disagree. And he went long shares of Herbalife. So fast forward 5 years, Bill Ackerman closed out a position. He lost $1 billion. Carl Icahn made $1 billion on that transaction. So that same scenario with GameStop and individual investors just occurs all the time, and that was a high-profile case. So I would say that yes, it's good for the markets, but that's not investing, especially when you look at the underlying companies. GameStop, the fundamentals do not support an individual buying those shares. It's just they targeted it. I think it's probably the 12th most shorted stock on the U.S. exchange at the time. So they targeted that one, and it turned out well. So that's the difference between investing and speculating. That was a speculation, and it worked out well. And all the power to people who did it, but I wouldn't recommend that strategy for the typical investor.
Okay, that was really interesting. Thanks for those thoughts. I think you made some great points.
Yeah.
And I also think this leads in well to my next question, which is about gold. I know that for you, you've said before, it's important to own gold as a store of wealth. So you're not as concerned about the everyday price movements for the metal. I do, though, want to ask where you see it going in 2021, just because we're at the beginning of a new year. People are excited.
Charlotte, what's our conversation about talking about gold, right? So, yeah, I think it's so short term, it's looking a bit weak. If you look at the technicals, it's 200-day moving average and then close to the 50-day. So it doesn't look good in the short term. However, we have Biden's stimulus package coming out soon. Gold does very well when there's liquidity in terms of bailouts and stimulus. So short term, if it does go down, again, reminder to the audience here: acquire. If you don't have enough of a position, add up to it or add into it. And the forecasts that I look at, that I review over the number of years, I think are the most reliable, call for the median term price. So there's a bearish case, moderate case, and a bullish case. And so the average between all three points to $2,300 gold by June 20 by next June. So Q2 June 2022. And so could it dip, below 1700? I think there's a small probability of that. But again, this is such a long-term investment. I'll repeat myself here. Just do not concern yourself about the price on this. It's tangible wealth. It's a long history of money, and acquire it. Worry about everything else in the portfolio. Ensure that what you own is actual gold, and we talked about in previous interviews. It's allocated and serial numbered and insured, etc. And then after that, worry about everything else.
Yeah, I think that's solid advice. And also related to gold, my impression is that you try to encourage your clients to go beyond traditional asset classes. Gold is one of those. With Bitcoin's recent price rise, I've seen it also increasingly mentioned as an alternative asset.
Mhm.
So, as we're finishing up, I want to ask you what you think about Bitcoin in relation to gold or otherwise.
You know what? I've long been a fan of Bitcoin. I've followed it since its inception. I think Max Kaiser was the first person I read back in 2012, possibly 2013, and followed it for a very long time. I've advocated for clients that have asked about it to own it, and so they've done extremely well. And in fact, our parent company just launched an IPO on a Bitcoin trust, and so one drawback with Bitcoin is it's not available for registered plans. So we had a $230 million raise that just launched on. So it's now trading on the exchanges as of yesterday. So yes, it is an alternative asset class. We can talk about this for a while. I think ultimately it. I fully believe that central banks do not like a competition to the printing press. And so that's my one worry about in the future. I mean, there's nothing guaranteed. So that does not stop me from, in terms of investing in it or recommending it. However, that's, in terms of pros and cons. So I think the price got way too extended, up to 40, 41,000. And so, settle back down in 30 range here. Be prepared for corrections in the 50 to 80% range. So this is extremely volatile asset. Chamath Palihapitiya, I really agree with what he says. He says 1% of your net worth in Bitcoin, and let's see here, prices of anywhere from north of $100,000 to $200,000 have been put around. I think that's actually very achievable given the nature of how it's set up. So 21 million coins, and that's all. So, it's definitely something to add. It's again, it's not gold, but it's not something to ignore. But be careful for the volatility. Don't get shaken out of it, and put just a tiny fraction of your liquid net worth in it.
Okay, very interesting. Do you have any final thoughts that you would want to leave investors with as we're heading toward the rest of the year?
Hmm. I don't know. I think FOMO comes to mind. I think
Mm.
there's a lot of asset classes that are just investors feel it's a very emotional. Investing is very emotional. I think they feel better when the prices are high, and so I think maybe just to take it, like just a gut check in terms of as they're putting their mouse over the button to hit buy. How are they feeling? Are they feeling? If they're feeling good, they're probably paying too high of a price, and so it's old sage advice is, if your hands aren't shaking when you're buying, then you're paying too much. So that's kind of a gut check just to think, are you chasing something? Has it run too high? The fear of missing out is very powerful. So, just be a contrarian. It's very hard to do. And with that takes patience, because it's not as if you buy something undervalued and then the next day it turns around. So that's one thing. And diversify alternatives have, I think there's a liquidity myth. Investors think if something's illiquid, it means it's risky. And that's not the case. In fact, there's something called the illiquidity premium, where you're compensated for a private investment being illiquid. And all private investments have different lockups. Some have 1 month notice, 2, 3, 4, 6, 12. So look to quality manager, quality advice. If there's any, there's a lot of do-it-yourselfers, but if there's any asset class or there's anything in this business where you need a quality team with a deep history, a deep fundamental understanding of these asset class, this is definitely it. They're not all created equal. There's a lot of work, and once that work is done, it still continues, because you need the ongoing due diligence, the monitoring, the oversight. It doesn't stop. And so with that, quality manager, and it can add just so much upside potential and limiting downside risk, and just steady returns that ride out corrections like this. So this is not the last correction we're going to see. There will be more. And if you don't mind stomaching a 35% drawdown and then buying it, and then it's few individuals that could do that, and then purchase at the bottom. And then so it's best, ending with where we began, build the arc, make sure everything's on board in terms of all your asset classes, and manage your downside risk.
Okay, well, that sounds like a great place to leave it. Thank you so much for coming on to talk again, and hope to see you again soon.
Yeah, you too. Thanks, Charlotte.
No problem. And
Right.
once again, I'm Charlotte McLeod with the Investing News Network, and this is Paul D'Souza with Sightline Wealth Management.